My name is Craig Blodgett. I'm your partner advocate here at Loanspark. My role is to support you with anything partnership related or scenarios you're looking to submit to us. Also on this call, I've got my head of capital markets, Thomas Black. So looking forward to providing some insights here on why short-term business loans are so effective and how they work. Before we jump into those details, I want to provide a quick market update. According to Market Research Future, the working capital loan market was valued at about 1.3 trillion in 2023 and is expected to grow at a compounded annual growth rate of 10.3%, which means that by 2023, we'll be reaching a total market valuation of 3.4 trillion. Of course, working capital loans can come in a suite of different options, but short-term business loans 99.9% of the time are used for working capital. So I think that kind of encompasses the broader theme here, which is the market's huge, and our goal as a partner of you is to help you tap into this market, help you fund more deals, help you attract new clients and retain existing ones. So let's define a short-term business loan real quick. Typically, these are going to be shorter term loans. We see term lengths between 3 and 24 months. And the payment frequency is going to be either daily, weekly, or bi-weekly. These are going to be factor rate based loans, meaning that we're not talking about an APR here. It's not going to be amortized the same way that a credit card would be, or a SBA loan or a term loan. It's a little bit different. So when we talk about a factor rate, let's look at a quick example. If we're giving a $100,000 loan amount over 40 weeks at a 1.2 factor rate, that means that they'll ultimately repay $120,000 back over the course of that loan. Okay, so for the example, we're looking at weekly payments, which means that if you want to calculate the total weekly payment, what you do is you take the 1.2, which is the factor rate, you multiply it by the loan amount, which comes out to $120,000, and then you just divide it by the total amount of payments, right? So if we're doing $120,000 total repayment divided by 40, we get in payment of $3,000 per week. So when someone asks you, how much is this loan going to cost me? Well, the factor rate reflects the total cost of capital, right? So a 1.0 factor rate would mean that essentially over the course of that loan, they're only paying money back. The amount of money they're paying back is only the amount that they borrowed. Going back to this example, a 1.2 factor rate means that they're paying essentially 20% or 20 cents on the dollar of whatever they borrow, right? So $120,000 total repayment for a 1.2 factor rate on $100,000. When would you use a short-term business loan? Well, the main themes are going to be high ROI activities and fast turnaround time needed, right? So if we look at some use cases here, and again, this is not an exhaustive list, but this is a good, summary of some of the best use cases would be an inventory purchase. As we know, we're coming up on the holiday season here. A lot of your customers that maybe own businesses that sell products will be looking to expand that inventory and make those purchases now to capitalize on the holiday season. So maybe you have clients that own e-commerce businesses, or maybe car dealerships, maybe they have grocery stores, that sort of thing, and they need to stock up now because they expect to make a high return on that inventory over the next couple of months. So that would be a great example of it. Another one would just be, like I said, working capital. This could encompass pretty much any use case under the sun that involves either expanding or sustaining their business operations. So it kind of goes hand in hand with the other use cases. Another one would be payroll, right? Maybe the business owner knows that they need to make payroll on Friday, but one of the vendors that they work with is going to be late on a payment. So you still got to pay your employees at the end of the day, right? So that would be a great example of where they need a fast turnaround time for that access to capital. And then, once the vendor comes in and pays the bills, they're able to pay off the loan. So they just need that kind of bridge funding to pad their cash flows. Marketing, that's another great example of when to use a short-term business loan. We have clients that have, website upgrades or maybe Facebook ads or something like that, and they need $10,000 to achieve this marketing. initiative when they know that they expect that they'll make $30,000 in profit, right? That's a high ROI investment and a great way to use a short-term business loan. Additionally, hiring of employees. So maybe you have a client who runs a trucking business, and they need to get some capital in place so that they can hire an additional employee, maybe get another truck so that they can fulfill a contract or expand their contracts and grow their revenues that way. So I think you're starting to understand the theme here is either high ROI investment activities and by the way, ROI, obviously return on investment. So high return on investment or fast turnaround are going to be, kind of the major theme here. When we talk about strategic goals, again, I think I've kind of outlined this, but convenience and speed, we can close these in less than 48 hours in most cases. And then if there's a kind of a factor that is playing into their approvals, these are going to be the highest approval type programs, right? So rather than going to their local bank or maybe some of the other financial institutions they dealt with in the past, we see 65% plus approval rates for the right customers on this program, which are much higher than some of the other products out there. Also, there's early payoff options available up to 100% interest forgiveness, which means that maybe your customer only needs a loan for 2 months, right? When we circling back to high turnaround, fast turnaround, or high ROI, maybe they only need 2 months. And so it wouldn't make sense for them to go through all of the hoops and jump through the hoops for a 10-year loan when they know this is a short-term need for capital. So those are some of the use cases and strategic we see a lot. Again, there are other scenarios that this type of product would still make sense, but that's a pretty good overview. At this point, I will turn it over to Thomas to provide kind of a more detailed look at how this program works, what we're looking for in a borrower. And again, he is my head of capital markets. So Thomas, take it away.
Awesome. Thanks, Craig. Yeah, so like Craig just mentioned, Thomas Black here, head of capital markets. One of my chief responsibilities with the company is to review your customers' leads when they come in and determine which of our programs is going to be the best fit to service their particular needs. So before we dive into these programs themselves, what rate and terms look like, how to secure the best pricing, what we need to submit, I want to talk a little bit about what type of customer we're looking for that's going to be a fit for these programs. So for simplicity's sake, we've broke this into 2 buckets. As you can see on your screen, we've got required criteria. So essentially the bare minimum that we're looking for to be able to finance this particular customer. And then preferred criteria, which is going to qualify them for the widest array of financing options. So on the required criteria side, we've outlined 6 months time in business. So just ensuring that they've been generating revenue for at least half of a year, a 500 minimum FICO score for the guarantor, and $5,000 a month in revenues or $60,000 annualized. And they can be borrowing in their personal name or an LLC. It makes no difference. Now, I'd like to point out, we do have a small variety of options for customers who have at least 3 months in business. And similarly, we may be able to finance customers with FICO under 500. We do not include these numbers in the minimum criteria because we believe their options would be very limited. And in the case of a customer with FICO under 500, you would want to have some mitigating factors. For example, monthly revenues well in excess of $5,000 or time in business in the several year plus range. So this is kind of a minimum starting point. If you have a customer that sits a little bit below these criteria, but you think they check the other 2 boxes, we're happy to take a look at the lead and see what we can do for them. This is kind of a good starting point for customers who have the ability to secure financing from us. On the preferred side, we're looking more for 2 years in business, FICO in excess of 650 for all the guarantors, and monthly revenues of $25,000 or $300,000 annualized. So again, customer doesn't necessarily have to meet these benchmarks, but they're going to secure higher loan amounts, longer term lengths, and better factor rates at the end of the day. And it is also preferred and considered lower risk when they are borrowing through the business entity rather than in their own personal name. All right, so how do we come up with pricing and terms for these loans? Well, similar to the slide I just presented, there's 3 main factors that are going to drive the rate and the loan amount and everything like that. So we just outline time in business, revenue, and their credit score. So these are characteristics that when they sit on the higher end of the scale, meaning they've been in business longer, they have higher monthly revenues, or they have better FICO, which is their historical ability to repay debt, then customers who score well in these areas are going to be perceived as less risky and therefore receive more favorable approvals. We've also got the industry category, and I kind of want to break this down into maybe two subcategories. So the first is going to be restricted industries. There are industries, for example, adult entertainment, weapons manufacturing. I would say cannabis is pretty widely restricted. There are certain industries that are considered off limits or restricted for most of our programs. Now, the cannabis one's a little bit different. We have a small variety of options there, and we can help out. But there are some industries like the one I just named and a few more that are going to be considered restricted. So it's going to be really hard to secure financing. And then you've got the second bucket, which we would call high risk industries. So the best example of this, and the ones that we see the most often, would be trucking and construction. So if a customer comes in who owns a trucking company and they're looking for one of these products, the minimum criteria that we outlined in the prior slide are not really going to apply. So rather than looking for 6 months in business, many of our programs require 3 to 5 years in business for trucking companies and monthly revenues in excess of $60,000, $80,000, $100,000, right? So because these industries are considered higher risk, they're going to require these borrower criteria metrics to be fulfilled, at a much higher rate, so to speak. And then a final factor that is considered occasionally, mainly for higher dollar amount requests, would be their business credit score. So this would be something like PayNet. There's other bureaus that report on these as well. So this is not going to be the case every time, but again, for customers looking for $200,000, $300,000, $400,000, this is something that's going to come into play when we run our risk model as well. Some auxiliary factors are listed to the right. So these are things like what position the customer is looking to secure funding in. So for example, if the customer has 2 outstanding short-term business loans and they're not interested in paying these loans off, then we would be looking to fund them in third position. So this is something that we can certainly accommodate. We can also accommodate a customer who has 12 outstanding short-term business loans and they're looking for the 13th position, but someone looking for the 13th position is going to have inherently fewer options, whereas someone looking for financing that's going to sit in the first position is going to have the widest array of options. We've also got factors like average daily balance and number of deposits, which are going to be gleaned from their bank statements when provided. So a customer may have $100,000 in revenue coming in on a monthly basis, but if their bank statements indicate that money is also being spent and possibly overdrafting their business account into the red, or they have negative days or NSS, which is non-sufficient funds, that's going to affect their terms as well and possibly result in a decline depending on which facility we're looking to provide. And again, number of deposits is another one. So if you have 2 identical customers who are doing each $100 a month in revenue, one customer does that across 100 deposits and the other customer does that with a single deposit. The customer who's taking majority of their revenue from a single deposit is going to be considered more risky because the volatility there is much higher. So if they have a down month, or that particular purchaser of whatever they're selling goes out of business or has a down month, then their monthly revenues are exposed to a higher level of risk. So again, the key factors are the ones on the left, some auxiliary factors are the ones on the right, and all of this combined is run through a risk model that's going to determine how much money we're willing to lend, what the factor rate is, and what the repayment terms look like. All right, so now I'll kind of cover best case terms for borrowers looking for these products, and then kind of give you an idea of the range that we'd be able to provide financing within. So starting with the term length, like Craig mentioned, for this short-term business loan product, we're considering this anything within 2 years. Minimum term length is generally going to be 3 to 24 months. Now, I should note that when an offer is presented, the term length is rarely expressed in terms of months. So If the customer receives an offer for weekly payments, the term length would be expressed in weeks. So rather than 3 months, you would see 12 weeks, 6 months, right, would be 24 weeks, etc. But for A+ borrowers, great time in business, great revenue, great credit score, we can go all the way out to 2 years. So the factor rate is, there exists a pretty wide range on these products for factor rates. But again, for A+ borrowers, we're looking at somewhere around the 1.15. So, cost of funds is 15% in excess of the money that they're borrowing. Now, for some of your customers, 15%, especially if you translate it to an APR, may seem very high, but I think there's a couple things to consider here. So one's going to be their sense of urgency. They may be able to secure cheaper financing elsewhere through, let's say, traditional financing institutions, banks, credit unions, etc. But those loans and lines of credit typically take 60, 90, we've even seen as long as 120 days to secure. So if they have an opportunity, like Craig mentioned, to purchase inventory before the holidays, and this is something they need to move quick on, that cost of capital, if they run their numbers, may be more than worth it to secure this inventory. Possibly they're purchasing it wholesale at a cheaper cost in order to capitalize on this momentary opportunity. Another thing worth noting is, like we mentioned, these term lengths can go out past a year. So if you see something like a 1.15 factor rate over an 18-month term, that's actually much less than 15% annualized, because it's 15% over a period of 18 months. And so if you ever have a customer who's concerned by the cost, especially if it's longer than a year, we're always happy to talk through what the APR actually looks like on these products and help them understand why this higher cost of capital may be worth it in the long run, right? So it's really a great fit for customers who may not be able to secure financing in the other way, but it also may be a great fit for customers who are highly qualified, but the products they qualify for would take 3 months to close. So factor rate starting at 1.15, ranging as high as 1.40, just depending on the risk profile of the borrower. And finally, the payment frequency is also a function of the risk profile of the borrower. So we would say best case scenario looks something like biweekly payments, so making a payment 2 times a month. This is advantageous for customers. Certainly, most businesses would rather make larger payments on a lower frequency, but again, that bi-weekly payment is going to be kind of reserved for A+ borrowers. I would say most of the businesses that qualify for these products qualify for weekly payments. And Craig kind of walk you through an example of how to back into a loan payment in regards to the payment frequency. So a couple examples to cover very quickly before I pass it back to Craig. So the first is the industry that I mentioned earlier is high risk. So a construction services company. So this customer is looking for $100,000, and I believe they had 5 years in business, monthly revenues were around $80,000. So this is actually another good point to bring up that we didn't mention earlier. Securing a loan amount somewhere around their monthly revenues is kind of what we're targeting. So a customer, business is doing $80,000 a year, is doing $80,000 a month, is doing $1 million a year. $100,000 is 10% of that, or right around that $80,000 mark, a little bit higher. So kind of anticipating an approval around 10% of their annual revenues, or on par with their monthly revenues, is a reasonable expectation. That range may be 5 to 15% of their annual revenues overall, but I think using that 10% number is a good proxy for where most of the approvals are going to come in. So again, customer had a solid risk profile. I believe FICO was in the low 700s, and we're able to secure a $100,000 approval with a factor rate of 1.18, which means over the 26-week period, they're repaying $18,000 in interest. Like Craig outlined before, you just take the factor rate, multiply by the loan amount. So they've got a total repayment amount of $118,000 divided by 26 weeks, and this 4538.46 is their resulting weekly payment. So for the second example, we're going to take a business that was in the technology industry. So this is a company that was doing, I believe, more than $250,000 a month in revenue. So in excess of $3 million a year. Seasoned business owner, excellent FICO, and I believe 10 plus years in business. So this is more of the example that I outlined earlier, where this is a customer that could go to Wells Fargo, could go to a local credit union and secure a line of credit probably somewhere under 10% and a facility that they can draw on regularly for working capital needs. But again, that's a product that's going to take 60, 90, even 120 days to close on. So for a business that's looking for faster capital and needs to purchase inventory in order to fulfill contracts that they've already have in place, they came to us looking for the maximum amount of money we could secure them that would get them through a year while they work on the other side of the house to secure a more flexible facility in the long run. So we're able to secure a $300,000 approval, which I will say is higher than average and on the higher end of what we offer. I mean, we offer these products up to $2 million, but $300,000 for most businesses is a fantastic approval. The factor rate on this loan was a 1.22. And while the term length was 52 weeks, so the entire course of the year, they did qualify for the biweekly payments. So rather than making 52 payments, they're making 26. So again, to back into the number, you're taking 300,000 times the 1.22, dividing it by 26 bi-weeks, I guess, so to speak, 26 increments of 2 weeks at a time. And you've got a shade over $14,000 as their monthly payment. So I think these examples kind of illustrate the flexibility and the wide-ranging nature of these programs. On the one hand, you've got a customer that is on paper highly qualified, but for their particular business use cases, just doesn't have the time to wait to secure maybe the cheapest financing that's available in the market. Because I think we all understand on this call, cheapest is not always fastest, and fastest is not always cheapest. So there is a trade-off there, and it's really up to the customer and the broker that's working with them to understand their business needs and understand what problem we're trying to solve. And on the other side of the equation, you've got a high-risk industry. So construction companies traditionally have a much harder time securing financing. And so, again, I think these examples really illustrate the value and flexibility of these programs. So with that said, I'll pass it back to Craig and let him kind of talk to you about how to market these programs to your customers and why they may be a great fit.
Awesome. Thank you, Thomas. So before I jump in here, also one thing to note would be that we do have tons of different types of programs. So if you have a customer who's more interest rate sensitive and has more time on their plate, that's of course something we can take into consideration and maybe look for a longer term solution for them as well. But in terms of how to market short-term business loans, there's a few different ways you can do that effectively. The most common that I see is with broker partners and referral partners, identifying the needs of their current and past clients. So maybe it's someone they're currently working with and they know that there's a need for capital. Either it's got a fast turnaround time or a high ROI expected. Or maybe it's just, like I said earlier, kind of a short-term need. So maybe they can expect to pay it off in 2 to 3 months. Maybe they, only need this capital for 12 months before they see that return on investment, right? Or maybe they have limited funding opportunities. We kind of already hashed out how our approval rates are extremely high with this program. So any of those needs or qualifications would be a great way for you to introduce a conversation about, applying for a short-term business loan. Also, if you wanted to retarget maybe some of your past clients, that's definitely a great way to kind of drum up some business here as well. So, just having that conversation with the clients you're working with either currently or in the past. Also, we see a lot of word of mouth referrals. I know there are several partners on this call who have relationships with either financial institutions or brokerages. And so they can tap into these clients that aren't already being serviced with short-term business loans by their existing financial institutions. So word of mouth is a great way to kind of let your clients know that, hey, I offer these programs now through a partnership. What can I do for you? Finally, I would say online marketing is another effective tool to get these kinds of leads in or to service these clients. We see a lot of our partners use Facebook ads, Instagram, maybe some sort of Google ads. Or they just go on more traditional methods and post on LinkedIn. Hey, I offer these products. let me know if I can help you, right? Something as simple as that can often get you a lot of leads. And then of course, email marketing campaigns. And so we've got some kind of email marketing material. We've got some, short form and long form content on the partner portal that you can access to, simply copy and paste, or just to repurpose it to your liking to help you let your network know that you're able to offer these products to your clients. Why you should fund these with Loanspark as opposed to another lender? Well, we have very fast closing times, right? So typically we see these loans close in less than 48 hours. I will say the exception would be if your customer is slow to either submit documents to you or documents to us. And then of course, if we're talking about a short-term business loan in the range of $1 million, right, there may be a little bit more scrutiny required, so the turnaround time may be a bit shorter. But in general, we're closing these loans in less than 48 hours. There's no depository relationship required with us here at Loanspark, which means that oftentimes your business client may need to set up a banking relationship with their financial institution. They may need to keep a certain amount of their capital in the bank in order to secure a loan with them. We're not going to require any of that. It's very fast and very easy, so they won't have to jump through as many hoops. Of course, we've got the ability to pick between many of our investors or funding sources with one application, meaning that most of the time when one of our clients gets approved for an offer, they may have a few different options to pick from. They may be more rate sensitive, or they may be looking for a longer term, depending on their needs. And with Loanspark, you have the ability to kind of vet through a few different offers, pick the best one for your client. If you're brokering, or your client has the best, or your client can pick the best one for them if you're just referring it to us. So lots of versatility there. Also, your clients stay your clients, meaning that on renewals, maybe they want to tap into additional capital down the road, or maybe they want to explore other options for financing down the road. They stay your clients and you are paid out on future deals. We have a lot of clients that come to us for one product type, their business grows, they come to us for another product type. For example, maybe they come to us for a payroll working capital loan right now, and then they want to expand their fleet and they need an equipment financing loan. And then maybe 6 months down the road, they're interested in SBA loan. With all of those different types of products, they stay your customers, and you're paid out on future deals. Our programs are very flexible. As I spoke to that a moment ago, right? We offer all types of financing here at Loanspark. We've got 300 plus programs, 30 plus years of experience on our team. We offer everything from working capital, short-term business loans, all the way over to real estate loans, equipment financing, SBA. So we can really be your one-stop shop here at Loanspark. On these short-term business loans, the margins tend to be pretty high. And I'll get into how the payment works here in a moment, but it can be a great way for you to close out the year here of 2024 with additional funding volume. And then, of course, you can broker and refer deals with Loanspark. And now I'll get into the differences between the two. With a referral, you're basically handing it off to us, okay? You get to focus on your bread and butter. So maybe you do a lot of deals in the mortgage space and you want to expand into business lending, but you don't really know where to start, or maybe you're not comfortable actually selling that term sheet. You can hand it off to us. We'll take care of it. We'll handle everything from document collection to pitching the offer, right? Explaining next steps to your client, explaining what the offer looks like, working with them to determine their needs, and we'll even close the sale for you. In that case, you'll make 20% of the gross margin, meaning whatever revenue Loanspark generates on the deal, 20% of that gets sent to you as a referral fee. In that case, we will also work with the applicant directly, which again means that you can just hand it off to us, move on to your next deal or next opportunity. Or if you're maybe a marketing company or something like that, you're generating leads online, you can focus on your marketing strategy and simply let us take care with our experience of closing the deals. Alternatively, I know there are a lot of brokers on this call. You probably prefer to have a more direct relationship with your clients, right? Maybe you want to make a little bit more per deal. That's fine too. You can broker deals with Loanspark where we will act as a direct lender. In that case, you would control the deal process. You'll be in charge of, collecting documents, pitching the offer to your customer, finalizing anything. We still underwrite everything in-house, but you'll be in charge of moving the deal forward. As a reward for that increased responsibility, of course, you get to name your commission. So you can typically upsell up to 10 points on these short-term business loans. And the way it would work is we simply work that into the term sheet. So whatever the origination fee may look like or the factor rate may look like, we add your points in. If you can close the sale, boom, done. And we pay it out at the end of the following month. Again, we work with you directly in that case. So while everyone's working on their questions, because we'll turn it over to Q&A here in a moment, let's go over our next upcoming webinar. I mentioned earlier, you can go, and I even pinned the message for our YouTube channel where you can find all of our previous upcoming webinars. We've covered everything from revenue-based funding to real estate, right? 1 to 4 unit, commercial, fix and flip. We even did a couple of equipment financing webinars this year. So definitely go on to that YouTube channel to get up to speed on all of our previous webinars. To close out the year, we're going to have one more webinar on December 11th, same time as today, and we'll be covering business lines of credit. Business lines of credit are a hugely beneficial program that we offer for a lot of our clients. And a lot of times we do short-term business loans and line of credit, or we provide SBA loans and a line of credit. So it's a great way for you to tag on additional options for your clients, better service them and create additional revenue for you as a partner. We may have upcoming training sessions next year, so stay tuned. We'll let you all know what that schedule looks like once we've locked it in.